1. The Fed, understanding the Federal Reserve System's role in the global economy. The Federal Reserve System, commonly known as the Fed, is a crucial institution in the world of finance and investment. Established in 1913, it is the only agency authorized to issue US dollars and plays a key role in planning and regulating monetary policy. Changes in the Fed's interest rates and money supply have a direct impact on the market and investors. 2. How the Federal Reserve's monetary policy impacts investors and markets. The decisions made by the Fed regarding interest rates and money supply have a significant impact on the financial market and investors. The Fed's current interest rate increase is aimed at controlling inflation, but warns of a higher risk of recession. Understanding the Fed's monetary policy is crucial for anyone interested in finance and investment. 3. Current Fed interest rate hike signals increased risk of recession. The Fed raised its interest rates to 0.75% in its June 15 meeting, the largest increase since 1994. This increase is aimed at curbing high inflation, but could push the U.S. economy into a recession in the short term, impacting the economic recovery process. Despite this, the Fed believes that the U.S. economy is currently stable. 4. The impact of Fed's interest rate hike on the global economy explained. The Fed's recent interest rate hike is expected to have a negative impact on the U.S. economy in the short term, with a reduction in consumption and investment. However, the U.S. interest rates are expected to rise to 3.4% by the end of 2022 and 3.8% by 2023, which will increase the cost of capital and debt repayment for households and businesses, while slowing down the economy. The upward momentum is expected to be more stable when inflation is brought under control and the unemployment rate returns to pre-COVID levels. The Fed will continue to tighten monetary policy due to global tensions and disruptions to production and supply chains. 5. U.S. interest rates set to rise, the potential consequences for households and businesses. The expected rise in U.S. interest rates to 3.4% by the end of 2022 and 3.8% by 2023 will have significant consequences for households and businesses, with increased costs of capital and debt repayment. The rise in interest rates will slow down the U.S. economy, but the upward momentum is expected to be more stable with the control of inflation and a return to pre-COVID unemployment levels. 6. Tightening monetary policy, the Fed's response to inflation and global tensions. The Fed's current tightening of monetary policy, through interest rate hikes, is aimed at controlling inflation and addressing global tensions. The recent increase in interest rates is a response to the current economic climate and is expected to have a negative impact on the U.S. economy in the short term, but the upward momentum is expected to be more stable in the future. BrokerJet. Financial Takeoff Point.